Multinational corporations operate across jurisdictions, using internal pricing to shift capital across borders, moving revenue out of high-tax regions into lower ones. Take the British authorities' investigation into Starbucks' UK subsidiary. Management reported strong business for a globally recognized high-margin product, yet the official tax records consistently showed losses. The UK unit was paying its Netherlands counterpart a 6% royalty on all sales for the use of brand intellectual property and business processes. This single internal expense was large enough to drag the UK subsidiary's net profit into the negative. That 6% royalty agreement acts as the transfer price between the two internal corporate units. By setting specific prices for the transfer of goods, services, or intangibles between their own divisions, organizations deliberately reduce the tax impact on their global earnings. Regulators recognize this mechanism. Global tax authorities actively scrutinize these internal transactions to prevent artificial profit shifting that starves their local treasuries. They enforce what is called the arm's length principle. Regulators demand that internal transfer prices mirror the open market terms that would exist if two entirely independent companies were conducting the same transaction. But defining an exact arm's length price is highly subjective. In India, the government introduced sections 92A through 92F of the Income Tax Act to create a strict regulatory framework governing these transactions. Solving a transfer pricing problem requires analyzing the situation through two distinct lenses. You must balance the physical, operational constraints of the manufacturing divisions against the jurisdictional tax differentials exploited by the parent company. Let's test this balancing act with a mathematical model. This diagram illustrates a car manufacturing company operating two distinct divisions, Division A in India facing a 30% tax rate, and Division B in Italy facing a 40% tax rate. Division A manufactures car engines in India. Over in Italy, Division B requires 5,000 engines annually to assemble its cars, which it can purchase from a local Italian vendor for an equivalent of 9,000 rupees per unit. If Division B buys internally from Division A, the transfer price is set at 10,000 rupees. But why would a parent company force its Italian division to pay a 1,000 rupee premium over the open market? This chart tracks Division A's capacity. Out of a 10,000 unit maximum, 8,000 are committed to external customers, leaving 2,000 spare units. Division B requires 5,000 engines. Routing this order to India exhausts the spare units and overwrites 3,000 external contracts. To fulfill the internal order, Division A has to curtail 3,000 of its external sales. To determine if this shift is financially viable, we calculate the contribution per unit. On the left, an external sale yields 3,000 rupees. On the right, the internal transfer also yields exactly 3,000 rupees. The internal selling price is lower, but internal transfers incur no selling expenses. That drops the variable cost from 8,000 rupees down to 7,000 rupees, keeping the net contribution identical. Since the per-unit profit remains stable, we calculate the net corporate benefit by isolating the new production volume. Accepting the internal order puts Division A at maximum capacity. Producing an additional 2,000 units at a 3,000 rupee contribution generates 60 lakhs in gross gain. Division A faces a 30% Indian tax rate. Subtracting this burden reduces the 60 lakhs gross gain to a net after-tax benefit of 42 lakhs. Let's look at Division B. Purchasing 5,000 engines internally at a 1,000 rupee premium creates an additional gross purchase cost of 50 lakhs. However, that 50 lakhs extra cost is a deductible business expense. Under Italy's higher 40% tax rate, that deduction yields a massive tax shield, bringing the net after-tax cost down to just 30 lakhs. Division A nets 42 lakhs, while Division B absorbs a net loss of only 30 lakhs. By routing the internal transaction through the 10% jurisdictional tax differential, the parent company generates an overall net benefit of 12 lakhs. Multinational optimization grows vastly more complex when you introduce the physical transformation of goods across entirely different global currencies. First, consider ABC Miners. They currently operate a raw emerald mining division in Japan, taxed at 20% and operating in yen, and a polished stone processing division in the UK, taxed at 30% and operating in pounds. Before calculating any profit margins, we have to standardize two variables: the exchange rate of 50 yen to 1 pound, and a physical yield ratio where 2 raw carats are required to produce 1 polished carat. That yield ratio dictates the volume of the entire supply chain. To generate exactly 500 polished carats in the UK, exactly 1,000 raw carats must be extracted and transferred from Japan. We need to price those raw carats. Let's start with the 200% of full cost method. We take Japan's variable and fixed costs, totaling 7,500 yen, and double them to 15,000 yen. Dividing by 50 converts that directly to a 300-pound transfer price per carat. At 200% of full cost, the transfer is locked at 300 pounds. Compare that to the market price basis. Local Japanese mining companies sell raw emeralds for 9,000 yen. Converted at the exact same exchange rate, the market-based transfer price drops to 180 pounds. That gap between a 300-pound transfer price and a 180-pound transfer price radically shifts where the corporation realizes its profit. By utilizing the 300-pound cost-plus method, the parent company artificially inflates Japan's recorded revenue, shifting a massive pool of profit into the Japanese jurisdiction. The parent company favors this inflated transfer price because Japan's corporate tax rate is only 20%. Meanwhile, the UK division, which faces a steeper 30% tax rate, gets to fully deduct those artificially high 300-pound purchasing costs. The accounting methodology used to calculate the transfer price acts as a legal slider. It allows the multinational corporation to quietly slide its global profit pool out of the 30% bracket and shield it within the 20% bracket. Transfer pricing is an ongoing tug-of-war. A corporation's drive to minimize global tax exposure is constantly checked by regulators enforcing market reality. To build these models under exam pressure, you must lock in the operational limits. First, spare capacity equals maximum capacity minus external sales. Calculating this is your mandatory first step before accepting any internal order, because it dictates your curtailed sales. Those curtailed units represent the true operational opportunity cost of the transaction. You measure that cost by finding the contribution per unit. Contribution must always be calculated separately for internal and external sales, as variable costs drop when internal selling expenses are eliminated. Finally, we calculate the net after-tax impact. The gross operational impact is mathematically meaningless until you multiply it by the specific tax rate of the country where the transaction occurs. Master these variables. They are the analytical tools you need to look past localized divisional losses and verify the consolidated corporate victory.